Hey, what's up, everyone? It's your favorite stock whisperer back at it again. And today, oh boy, we've got one of those market mornings where you look at the screen, see record highs, see tech ripping, see oil cooling off, gold getting smacked, and you say, wait a second, weren't we just panicking like 5 minutes ago? Yeah, welcome to the stock market. 1 minute, everybody's worried about war, inflation, oil shocks, shipping routes, rate hikes, and global chaos. The next minute, the Dow is sitting at a record high. The Nasdaq is ripping like it just found a fresh cup of espresso. Mega-cap tech is back in beast mode. And Wall Street is acting like the last few days of selling were just a dramatic group therapy session. So today, let's talk about what's actually driving this move. Because this is not just another green day. We've got geopolitical relief, a mega-cap tech rebound, Alphabet joining the Dow, Apple dealing with a supply chain mess, SpaceX getting index momentum, and a Fed that suddenly looks way more hawkish than traders wanted. And yeah, the Japanese yen just hit its weakest level against the dollar since 1986. Crazy, right? Let's talk about it. The Dow Jones Industrial Average just closed at a record 52,182. The S&P 500 closed around 7,440, up about 1.18%. The Nasdaq Composite jumped more than 2%, closing near 25,820. But the Russell 2000? Basically flat. And that tells you something important. This rally is not being carried by every stock in the market. This is not a buy anything with a ticker symbol kind of move. No. This is mega-cap leadership. This is tech. This is AI. This is investors running right back into the names they trust when the market starts feeling better. The generals are charging, but the soldiers are still standing around asking, are we sure? Now what flipped the switch? Geopolitical relief. After months of tension between the U.S. and Iran, the two sides signed an interim ceasefire memorandum of understanding, and markets are treating that like somebody turned down the global risk thermostat. The big fear was energy disruption, especially around the Strait of Hormuz. That's one of the most important oil shipping choke points in the world. When that area gets tense, oil traders sweat. Inflation fears come back. The Fed gets nervous. And growth stocks start looking over their shoulder. But with ceasefire talks moving forward and shipping fears easing, a lot of that panic premium is coming out. Oil is around $70.75 a barrel, up a little today, but still well below those May panic highs. Gold dropped about 1.8% to around $4,014 an ounce. And I know, gold at $4,000 still sounds insane. Welcome to 2026, where your coffee costs $9 and gold is apparently renting a penthouse. But the move matters. Gold selling off tells you safe haven demand is fading. The VIX is near 12.45, which tells you traders are not exactly panic buying protection this morning. So the market is basically saying, okay, the fire alarm is quieter, let's go buy growth again. And where does that money go first? You already know. Tech. The Nasdaq jumped more than 2%, powered by mega-cap tech and AI-related names. NVIDIA finally snapped a 5-day losing streak, closing up about 1.3%. And that matters because NVIDIA is not just another stock anymore. It has basically become the mood ring for the AI trade. When NVIDIA is weak, AI traders get nervous. When NVIDIA stabilizes, suddenly everybody starts acting like the party lights are back on. Now let's talk about Alphabet. Alphabet, ticker GOOGL, jumped nearly 5% in its first session as a Dow component after replacing Verizon. That is not a quiet entrance. That's walking into the party, kicking open the door, and asking who brought the guacamole. This matters because the Dow is the old-school blue-chip club. And Alphabet joining the Dow tells you exactly where the market sees modern leadership. Legacy telecom out, mega-cap tech in. That's the whole market rotation in one headline. Now, Apple has a different kind of headline. Apple is dealing with a serious supply chain issue after a ransomware attack hit supplier Tata Electronics. Sensitive component details for the upcoming iPhone 18 Pro reportedly leaked on the dark web, including component lists, supplier data, and photos. Now, is this going to destroy Apple? No. Let's not get dramatic. Apple has survived worse than leaked phone parts. This company has a cash pile that looks like a national budget, and customers who treat new iPhones like a holiday. But it does raise a real question about supply chain security. Apple has been diversifying production outside China, which makes sense. But when you spread your supply chain across more regions and more suppliers, you also create more doors that hackers can try to kick open. That's why investors are watching this. It is not just an iPhone leak story. It is a security, supply chain, and execution story. Now, SpaceX also made noise, surging more than 7% after news it will be added to the NASDAQ 100 starting July 7th. And you already know what that means. Passive index buying. Funds that track the NASDAQ 100 need to adjust. Traders love trying to front-run those flows, and when a company like SpaceX gets added, attention builds fast. But remember, index inclusion is a catalyst, not a guarantee. Don't do the green candle blackout strategy. That one usually ends with you staring at your portfolio like it betrayed you personally. Comcast rallied too after announcing plans to spin off legacy media businesses from its core broadband and connectivity unit. Not as flashy as AI chips or rockets, I know. Nobody wakes up screaming, "Honey, Comcast is restructuring!" But these moves can matter because they give investors a cleaner story. Markets like clarity. They like knowing what they're actually buying. Now let's get to the Fed, because this is where the rally gets complicated. Under newly appointed Fed Chair Kevin Warsh, the Fed has taken a more hawkish tone. Inflation is still sticky, energy volatility has not helped, and markets have gone from hoping for rate cuts to pricing in at least one rate hike before the end of 2026. That is a big shift. The 10-year Treasury yield is around 4.45%, while the 2-year is near 3.98%. So while stocks are celebrating less geopolitical risk, bonds are still saying, "Hey, not so fast." Inflation is still hanging around like that guest who will not leave. And this is the tension in the market right now. On one side, you've got lower geopolitical risk, cooling oil fears, and renewed love for mega-cap growth. On the other side, you've got a Fed that may be forced to stay tight or even hike if inflation and labor data keep coming in hot. That brings us to the big event this week, Thursday's June jobs report. The U.S. economy has already delivered 3 straight months of hotter-than-expected jobs data. If we get another hot non-farm payrolls number, rate hike expectations could get even louder. That could push yields higher. And higher yields can pressure growth stocks because expensive valuations get harder to justify when money costs more. Simple version? Tech can run in a higher rate environment, but it has to prove itself. Earnings have to deliver. Margins have to deliver. AI spending has to deliver. Guidance has to deliver. No excuses. Now let's talk currencies, because the yen is getting absolutely smoked. USD/JPY hit 162.40, which puts the yen at its weakest level against the dollar since 1986. Why? Rate differentials. U.S. yields remain much higher than Japan's, and traders are testing whether Japanese officials will step in. That 162.50 area is key. If the Ministry of Finance intervenes, the move could be fast, sharp, and ugly. So even if you only trade U.S. stocks, keep an eye on the yen. Sometimes the thing that moves your portfolio is not the thing you're watching. Sneaky little market goblin. Crypto, meanwhile, is trading mostly in line with high beta tech. When NASDAQ risk appetite improves, digital assets tend to catch a bid too. But Bitcoin is still sensitive to Treasury yields and Fed expectations. So again, it all comes back to rates. Oil is calmer, gold is weaker. The dollar is still firm near 101.09, and global markets are following Wall Street higher, with South Korea's Kospi up about 1.17% thanks to chip strength tied to Samsung, SK Hynix, and the broader AI hardware boom. That matters because AI is not just software. It is chips, memory, data centers, power, cooling, networking, and infrastructure. This is a full capital spending cycle, not just a chatbot story. Now, today is also the final trading day of Q2 2026, so watch for quarter-end rebalancing. Institutions may adjust portfolio weights near the close, and that can create weird moves. The final hour could get jumpy, so don't assume a calm morning means a calm close. Now let's bring it all together. The market is enjoying a relief rally. Geopolitical risk is cooling. Oil shock fears are easing. Volatility is down. Megacap tech is back in demand. Alphabet is in the Dow. SpaceX has index momentum. And AI names are trying to reassert leadership. But here's the kicker. The Fed is still a problem. The market has gone from expecting rate cuts to pricing in rate hikes. If Thursday's jobs report comes in hot and the 10-year yield breaks higher, this rally could face a real test. That does not mean you hide under the bed, but it does mean you stay sharp. Because record highs are exciting, but record highs with a hawkish Fed? That is not a sleepy setup. That is a keep your head on a swivel setup. Real quick, you already know the deal. I'm not your financial advisor. This is not financial advice. This is for informational and educational purposes only. Always do your own research, manage your risk, and never risk money you cannot afford to lose. So today, I'm watching mega-cap tech leadership. I'm watching whether small caps start participating. I'm watching the 10-year yield around 4.45%. I'm watching oil in the low 70s. I'm watching USD/JPY near that 162.50 intervention zone. And I'm watching for quarter-end weirdness near the close. Because the bulls are back, but the bond market still has a vote. All right, team, that's it for now. Keep your watch list sharp, keep your coffee strong, and keep your emotions out of the driver's seat. This is the Stock Whisperer, and you already know, I'll be watching.